Welcome back to the latest edition of the InvestTalk Market Analysis for the week ending December 15th, 2023. Appreciate you all tuning in and subscribing to this channel as well as our podcast, InvestTalk, and be sure to like this video as well. Now, this week I'm going to title the video, A Dovish Fed Ignites the Santa Claus Rally. And we are in holiday season, just less than 10 days away from Christmas. And this is typically a time where there's not a lot of volatility in the markets, and we'll dig into that in a little more detail. But first, let's look at the economic news. We had the CPI on Tuesday that came in lower than the month of October, so 3.14, the lowest level. We had 3 in June, but you can see small bounce over the late summer into the fall, and now we're back into a decline for 2 months in a row. So you also had core prices month over month that did accelerate a little bit, but overall, year over year, we continue to decelerate. The PPI came in on Wednesday, and year over year, that's nearly flat, right? Back to below pre-pandemic levels. We are at 1.11 in February of 2020. Core PPI, remember, producer price index, is usually leads the CPI by about 3 months. And so if this is at 2, you're talking about levels that are roughly in line with kind of pre-pandemic levels. Okay. So, it's pretty clear that inflation is dead to an extent. You have export prices that tick down again in the month of November, negative 5% year over year. Import prices, negative 1.4% year over year. You also had retail sales that improved a little bit, so that was positive, and same with industrial production. But what you can see is the economy is holding up relatively well. You see that with the retail sales and industrial production, and inflation continues to moderate. And that ignited the sentiment from the Fed, and not just Jerome Powell, but many of the Fed members, that they are done. They're done hiking. And this was kind of the solidification of increasing expectation the Fed is no longer going to raise rates in the cycle. They are done, and the next will be a rate cut. Now, they're prognosticating, based on the dot plots, 3 rate cuts next year. Could it be more? Sure. And then the market's kind of pricing that in, right? You go all the way back out to December of next year, and what you have is 375 to 400. So you're talking about 150 basis points from where we are today. So that's 6 rate cuts that the market is pretty much priced in next year. And the big question is that too much? Has the market gone too far? And we certainly will see. Certainly, we'll see how the economy evolves. Obviously, it's softening to a degree, continues to soften, but it's not recessionary. Now, we do expect a recession at some point next year, but a mild one. And the question is, does it justify an aggressive rate cutting path? And the market thinks it does. The Fed doesn't think that it's going to be aggressive, right? It's saying, we'll cut rates 3 times next year, but maybe starts in June, and it's in every other thing, right? Where you have June, September, and December. That's kind of what the Fed dot plots were saying. Whereas now the market expectations for March are a 67% chance you'll get 1 rate cut in the first 2 meetings of next year. And May, a very, very high likelihood that there will be a 95% chance there will be at least 1 rate cut by May. So the market is now pricing in this is going to happen sooner rather than later. Is it? I don't know if I really believe that, but it's what the market is saying. And you have to certainly listen to it. Now, let's pivot over to the charts. Now, what's interesting here is the growth of value. You would think that if interest rates come down so much, the growth side, which had a big drawdown last year, rallied a lot this year, it would reignite to the upside. And the exact opposite has happened. And I think that has more to do with the fact that, hey, the dollar is now in a downtrend, and that's going to benefit certain commodity markets, certain industrial markets that are a product more of the value side of the market. And same with financials. Banks doing well. Here's the KBE index that has had a big move on the back of rates coming down. And that's really what this is about. The 10-year going from 5%. We were there. Look where we were. This was October 23rd, less than 2 months ago. Less than 2 months ago, we were at 5%. Closed the week at 3.9. Let's call it 3.93. So over 100 basis point decline in the 10-year. That's something the banks love. They love seeing that. We know they had a lot of losses on their balance sheets that were going to, going to excuse me, that's the word I'm looking for, weigh on the profitability and the solvency of their business. So that's certainly helped that side of the market. And then small cap to large caps. Here's the IWM to the SPY. That's certainly started an uptrend as well. So I think we're early on in this rotation, right? For all of last year, small caps outperformed the large caps. And then you had that big breakdown basically in the month of March when a lot of those small caps, small regional banks broke down, and you had that longer term, that trend. And now that's reversing. I think it's still in the early innings. So we'll see if we get any follow through. We definitely got some follow through this week after a breakout last week as well. So that's looking pretty good. The broader indices, the NYSE, let's take a look at that there. New highs for the year. Let's zoom out, see what kind of progress we've made. This is a pretty choppy environment that we've been in really since the beginning of 2022. You had that big sell-off into the fall of last year and a choppy uptrend, and we remain in a decent uptrend. And if you zoom out to the S&P, we are, let's clean this up a little bit. This is not a fib that has relevance anymore. We are getting up into the highs from January of last year. So the market now, after this big rally, is basically flat over the past 2 years. And could we make new highs? Probably not this year, but because that's going to be major resistance. But in time, I do think we can get that in the first quarter. I do think there will be some more volatility back half of the first quarter, second quarter time frame. It would not shock me at all. But for now, with Santa Claus rally, we're probably going to get a decent market into year end. Let's look at some other indicators. We have the MOVE index there. That continues to be in good standing, remaining below that 150 level that we always talk about. And obviously with the Fed becoming dovish, that certainly helps the treasury market, treasury prices rallying, etc. Let's take a look at the VIX. It's another indicator that shows you low volatility means higher asset prices, and that isn't really doing much. It's just kind of flatlining down here at very, very low levels, positive for risk assets. You have the interest rate sensitive parts of the market certainly doing well. Now the question is this rally done? Right? You've had this. This is what I was expecting going to the Fed meeting. I was actually expecting the market to turn, buy the rumor, sell the news type of event, and the market didn't. Right? The market has so far taken a leg higher. Now we did get a pause in the S&P on Thursday and Friday. Remember the meeting was on Wednesday, closing near the highs of the day. But this just could be consolidation. Small caps, however, had a big move on Wednesday, a follow through on Thursday, and a bit of a give back. But if we get below Wednesday's low, that suddenly portends to maybe a pullback in the short term. So we'll see if you get more kind of consolidation to attack those highs again and build power for that next leg higher, because right now the market's very overbought. So to see more gains next week, in a substantial way, I think it's going to be hard to see. I think you get at a bare minimum consolidation and potentially a bit of a pullback, especially because some of the Fed, there was a Fed governor that on Friday basically said, maybe the market's getting ahead of itself, that we're paused, but we're not going to cut rates anytime soon, type of thing. So I think they could be seeing the market reaction and kind of pushing back on that. Let's take a look at the The corporate bond market, corporate yield spreads, that also is another indicator that, we maybe are pretty close to a near-term top. Credit spreads are not tightening further, right? You've seen that rally, saw that rally on Wednesday, Thursday, and Friday. You had a give back. So if that starts to roll over, it's another thing I'm watching. So the more I look at these charts, I have to say I don't see a lot of major upside in the short term. Always could be, right? We're in Santa Claus mode. We tend to have light volume float into year end, but when you're this overbought with so much dovishness priced into the market, it would not shock me to see a bit of a pullback by year end. So I would say for now, I'm neutral. I'm neutral on equities into year end. I think it can go kind of either way. Probably not in a big way. Probably not big up moves, not big down moves. I think you get choppiness overall. What do I want to get to? Oh, gold. Gold obviously had a nice pullback and then a rally post Fed meeting. As long as it stays above that Wednesday low, this is overall a pretty good pattern for gold. Let's take a look at silver. Silver also getting a big move on Wednesday and Thursday with a follow through, kind of like the small caps. And once again, as long as we stay above that Wednesday low, I think silver is in a good place. The dollar, and another thing I will be watching. We got a bit of a rally on those Fed comments on Friday. As long as we stay below that Wednesday high, I think you see lower dollar prices. Let's see if there's anything else I want to add. I always have my notes here in my phone, so that's what I'm kind of looking at to see what I want to talk about. But I think that's about it. Oh, here's it's XLE. Let's look at some of the sectors. That has a nice move. This overall still is in a longer term uptrend, right? Higher highs, higher lows with the XLE. You had some concerns with, I believe it's the Red Sea, closing of the Red Sea. So geopolitical concerns could ignite, I think, the oil market sometime between now and the end of January. So be on the lookout for that. I do think that's that has some catch up to do with the rest of the market. Industrials obviously overbought, but I think this is telling you this is a positive. This is telling you that a major downtrend in equities is probably unlikely. Typically, you get a lower low before you start a downtrend, and we're getting higher highs amongst all the major major sectors. The only thing that I would be a bit worried about are those interest rate sensitive sectors. So here's the real estate, right? REITs have rallied big, but what you can see is we're not above the highs from earlier this year. Until we get there, I still think you're in a series of lower highs, lower lows. You're in a downtrend. Same with XLU. Okay, downtrend, not making higher highs. So you have to focus on the sector allocation. I still think you have to be a bit wary of duration risk. And after this big move, I think this is an opportunity to think about, okay, how do I shorten my duration? If you're in longer term bonds or in a bond fund that has longer duration, it's had a rally. Is this an opportunity? We'll look at like ag, for example. Here's the aggregate bond index. So you can see this is just rallying to the 100-week moving average. That's going to be resistance and the highs from earlier this year, late last year. And until you get above that and make a higher high, this is still in a broader downtrend. And so I think you still have to be bullish equities modestly in the medium term, maybe not the short term. And bonds, you have to keep your duration short. I still think there's not a lot of credit risk out there, especially in the public markets. I think private markets, private credit funds, things like that can have issues. But overall, this will be a very interesting 2024. We have an election. We have a Fed that is currently has tight policy that's hinting at looser policy, but certainly could pause for longer if inflation doesn't continue to cooperate. And you have an economy that continues to slow. But obviously, with looser financial conditions, with the weaker dollar, with lower interest rates, that's certainly going to help the economy overall. So certainly a mixed picture, but overall, you still have to be relatively bullish. Markets are not overvalued generally. Now, the Mag 7, I could argue that is an area that probably is looking like it could struggle. Google's a good example, right? Look at the series of lower highs. It's a wedge pattern, really. You have a few lower highs here. You had the AI day last week, and it's basically been down ever since that AI day. You look at an Amazon that is looking to go to new highs, so that's been positive. Apple, same thing. There's some relative strength there. Let's take a look at Microsoft. I'll go through all the Mag 7. This is a mini bearish pattern here with the markets breaking out. This is not. That's what's interesting here. Look at that last 3 days. The markets have been surged. This is down. So that's something to watch as well. The Netflixes of the world, Netflix, same thing, right? It's surged, but it's pretty much given most of that back. Tesla, that one still is making a series of lower highs and lower lows in a downtrend. Had a nice few days with the rest of the market, but relative to, small caps, for example, let's do this. This is rolling over, right? This is Tesla to IWM. This is making a series of lower highs, lower lows. So the major magnificent Mag 7, let's look at Meta. Yeah. Look at this lack of real follow through the past couple of days. And that I think what could drag the rest of the market down. Okay. So we'll see what happens as we close the year. We're overbought. We have a Fed that probably doesn't want to let the market get too far ahead of itself in this pricing and cutting, and doesn't want to stoke inflation while things are improving. They don't want to speak too soon and say, okay, the battle against inflation is done, but clearly there's been progress. So that's where we're at, kind of a neutral stance into year end. But, as we go into next year, major pullbacks, let's look at the S&P. Now, I was talking about how controlled this pullback was through seasonality, August, September, seasonally weak parts of the market. And this is very controlled. And it kind of pretended to maybe not this quick of a move in the markets, but a resumption of the uptrend, and we have that. So I could easily see any pullback only being minor, right? If you have a gap here, gaps tend to be filled. So it would not shock me to see, okay, a pullback over the next month, kind of starting, and getting back into those levels where we had that gap. But that would be a pullback to buy overall at this point. Okay. So that's where we're at. Appreciate you all tuning in to this channel, like and subscribing. Once again, a reminder: the contents of this video are for educational purposes only and should not be construed as a recommendation to buy or sell a security or to participate in investment strategy. The views are my own and do not represent those of KP Financial or those associated. Have a wonderful weekend.